Hey everyone, happy July 4th. I'm definitely already in the pool by the time you watch this. Today is an American holiday, so let's take 10 minutes and learn about the largest market crash in American history.
Good evening. Today is Black Monday, the day the Dow dropped more than 500 points. The day the Dow dropped more than 22%, almost double the rate of the Black Monday that signaled the beginning of the crash of 1929.
22%
But this
in
crash
one day.
of 1987 is not just an American experience. Around the world, stock markets fell faster than a skydiver without a parachute. The panic starting in Tokyo this morning while the West slept. One cause of the sell-off was reaction to last week's 236-point drop in the Dow. The result, the Nikkei average was down 260 yen. Then, like a plague, sell fever headed west. In Frankfurt, fears of higher interest rates in the U.S. triggered the drop there. In 2.5 hours of trading, the Commerzbank share index fell 132 points. In London...
So they're talking about how this crash is affecting the world. And something you'll see with markets, it's kind of like, it works like a tide. The tide comes in, it comes out. And, we're talking about a crash here. In this case, the tide of money is flowing out, right? It's flowing out of these stocks. And then you'll have times where the money flows in. What you'll find is that the money flows in over a much greater period of time. It's slower. That tide comes in slower, but it's over a much greater period of time. Versus when the money's flowing out, that happens very quickly. So, right, that money slowly comes back in, but then when it goes out, it leaves very quickly. And we're talking about the world here, so it impacts the whole world. The whole world thinks like that. So if one group, especially as influential as the United States, if money is flowing out here, then that has a ripple effect.
An even larger drop. The British market, trying to cope with Friday's national computer failure, was thrown into a near panic. The result, the London Financial Times index down more than 183, the biggest one-day drop in Britain's history. And from there to Wall Street, where the numbers speak for themselves. Unofficially, the Dow stands at 1738.
So look at the Dow price there, 1,700, and today it's nearly at 45,000. So. Right, we have the whole world here is in like crisis mode, but in I guess almost 50 years now, it's going to be more than 20 times higher than what it is currently.
0.41, a drop of more than 508 points, with a volume of more than 604 million shares. Proof, as Alec Roberts reports, that the panic hit a fevered pitch.
From the opening bell, the market was in free fall. After last Friday's record 108-point loss, analysts had expected a rally. Instead,
it's a panic. Everyone's in panic. Everybody, we're trying to find a bottom. We're trying to, as a floor broker, I see stocks trading 10 points below where they traded Thursday, and I'm saying this has to be the bottom. And then they trade 5 points lower than that.
By noon, the market was down about 150 points. The tape delayed by more than an hour. But it only got worse as trading brokers struggled to cope with a blizzard of sell orders.
New Mexico, we have some work here to do.
Look how
Since the
manual
market hit a high
everything
of
is too back then. Now, I mean, like all the trades are taken with either automated or with a computer click. And back then, to take trades, there had to be this whole process with actual humans being called and running, like physically running to place orders. So that was a different world there.
2,722 last August. It lost 17.5% of its value to 2246 by Friday, and another 508 points today.
I don't want to pause the video too much, but look at this.
2246 by Friday.
Look at this.
And another
this really quick drop
508.
that happens there. I mean, this is common. The market it's drifting down, and then you have this sudden quick drop, and often that sudden quick drop late in the sell-off, then that's often the final move down. And recently when we had like the sell-off because of the tariffs in April, that's something I was talking about. When you see this volatility increase, that when the VIX goes above 35, that often ends up being the end of that move down. People were selling, and there was too much selling, and you actually run out of sellers. and you're only left with buyers that late in a sell-off.
8 points today. More and more analysts believe that the bear market is here to stay. It's not that the economic news is so much worse. In fact, some indicators are showing unexpected strength. It's the psychology that's changed. While for 5 years investors have looked at the economy as a glass that is half full, now they're seeing it as half empty. Reasons for the decline have been floating around for months. An accident waiting to happen, according to one analyst. Renewed inflation fears with the decline in the dollar, rising interest rates, and huge budget and foreign trade deficits, a nation living for too long beyond its means. The results of the decline will hit millions of people in their investments, pension plans, their mutual funds, and eventually every segment of the economy. Higher interest rates, for example, will hurt the housing market. Even normally optimistic analyst Larry Wachtel doesn't see a quick recovery.
What usually happens in cases like these where the psychology has been so scarred is that once there is a technical rally back in which people unload on the rally, then you go through a long quiet period. The people that got out don't want to get in. The people that wanted to get in aren't sure about whether they want to get in now. And so you go through a long quiet convalescence period.
President Reagan, however, was more optimistic.
Where our productivity is up, so is our manufacturing product up. There is no runaway inflation as there has been in the past. So, as I say, I don't think anyone should panic.
So obviously, the president's job is to be optimistic and keep the positivity and continue to steer the ship. But that's really the view investors should have. If we learn anything from Warren Buffett, he says don't bet against America. And that's held true for centuries now, and that's going to continue to hold true for as long as our lives, as long as anyone watching this video. Our population's still increasing, technology's increasing at a faster rate. We're going to continue to have dips, and like I said, at least in our lifetime, that market's going to continue to end up higher than where it started.
In New York, this is Alec Roberts reporting.
Oh, but panic they did. Joining us now is Stephen Malin, senior economist for the Conference Board, the country's largest business-sponsored research organization. Stephen, there is late word tonight. I don't want to spring this on you unawares that on the Tokyo Exchange, there's a little bit of a rebound, or actually they're calling it a strong rebound on the dollar market there. Would that be an indicator that things here might sweeten up tomorrow?
Well, I don't know if that's a sign that things will sweeten up. It's a sign that I think that the people in Tokyo don't want to see any more pessimism in America. It's a mild sign of slight confidence, but it...
So that they're talking about Japan 1987, and I want to bring this up quickly. Japan 1987, so here's that 1987 crash. It's fairly small, and then the market ended up almost doubling that over the next 3 years. Now, an issue Japan ran into, as you can see, the market really never recovered until just recently, 35 years later. Now, what's the difference between the two economies? Like, why are we so positive on the United States? Why do we continue to buy the dip on the United States, yet we have historical examples of something like as significant as Japan falling for 35 years? Well, Japan ran into population problems. Right, they had that very large. They had a demographic bubble, a band right around this time that were around 35 years old, 40 years old, and that's what created this massive spike in that massive economy. And as that group aged, there was no larger band to come and replace them, and then they ended up with all these lost years.
It is not a sign of optimism at all.
What would it take to stem the losses here?
Well, tomorrow's indications would be that you would see a market which is much less violently up and down. If we see something which is down but not violently down, if we see trading volumes which are not quite so large, I think we would see a sign that this is starting to stem.
In terms of 1929, which everyone's comparing this to as saying it was double that in terms of percentage of loss, there are a lot of other things that don't match up with 1929 in terms of the economy. How do you assess the effect this would have as opposed to the one in 1929?
Well, this is a very different economy in the sense that it's a lot stronger economy, and most of all, it is a global economy. The 1929 economy did not have the openness of our markets. We are much more now a trading economy, an economy that relies on those foreign markets. And the key foreign market, as we learned today, is the financial market.
Now, what about looking at the blue chip stocks that everyone analyzes for mutual funds? They're very cheap tomorrow morning. Would you be interested in buying them this early?
No, I wouldn't touch anything yet. What we're going to have to do is look at what happens when we wake up in the morning tomorrow and see what happened in the Asian and European markets.
So I wanted to bring this up. He's talking about he wouldn't buy. Here is the historical data. This is the largest daily drops in history for the Dow Jones. So here it is. That day was the largest drop ever, 22%. On the left is the largest gains in history. And then 2 days later, on this Wednesday, was the 8th largest gain in history. So they had a 10% gain. Of course, in hindsight, we can say, oh, he should have been saying we should be buying. But I just bring that up because historically there's so many examples of huge drops followed by the largest gains in history. And I'll continue to bring up these points like that when you see a large drop, especially after an extended drop that's already occurred, and you're getting this like even more massive sell-off like near the end, and that's what commonly follows that are actually the largest gains in history.
What could very well happen is that we're going to see signs of more chaos, and if we do, then you want to stay out.
Stephen, do you see any winners in what happened today?
Well, I'd like to be a stockbroker cashing in on some of the commissions today.
That's a good point he brings up there. The stockbroker is just the middleman. They're just basically salespeople, and they're just collecting commissions on those, the transactions of sales. All right, I hope you guys enjoyed that. It's always important to study the historical events and study just what's happened in the past, and because we're still humans, we're still going to create the same problems and find the same solutions for them, and it's going to keep happening over and over. So it's always important to just look back and review these kinds of things. So enjoy your July 4th. Don't spend too much time studying. Go out and get some sun. I know after this I'm going to go get in the pool, so enjoy your July 4th.